In Budget 2026, the Singapore government finally shared more details about the long-awaited enhancement to the CPF, which is also known as a Lifetime Retirement Investment Scheme, or LRIS. It's hard to believe it, but the LRIS was first recommended by the CPF Advisory Panel almost a decade ago, and now it is almost finally here. Yay! With the LRIS, investors can now easily invest their money into a simplified, low-cost and diversified portfolio that is automatically rebalanced as they move closer to retirement. So in this video, we will go through what the LRIS actually is, how it actually works, and most importantly, who this scheme is really meant for. Let's not waste any time and let's jump right in. So first up, why do we even need to introduce another new scheme? I thought we already had the CPF investment scheme. Well, that's true. Under the existing CPFIS, members can already invest their CPF savings into a wide range of products, from unit trusts and ETFs to shares, insurance-linked funds, and even gold. In theory, this will give CPF members plenty of options to earn higher returns, instead of just settling for just the 2.5% to 4% returns from CPF. But in reality, CPFIS has not worked very well for the average investor. According to a report by the CPF board, from 2016 to 2024, around 29%, or almost one-third of members who invested their CPF money either lost money or underperformed the 2.5% risk-free interest rates from the CPF ordinary account. Ho say bo. And this wasn't even a bad market period either. Over the same time frame, major global markets did very well. For example, the S&P 500 delivered close to a 200% return. The global equity index returned around 150%, and even the STI, or what some people like to call super terrible index, still managed to give close to 90% gains. And yet, despite this strong performance, a large portion of CPFIS investors still did poorly. Why? This points to a deeper issue. It's not that the markets are bad or that investing is impossible. The problem is largely behavioral. When investors are faced with hundreds of choices, many may end up buying high-fee funds, chasing past performance, jumping in and out at the wrong time, or switching products too frequently. And all these small mistakes will quietly eat into long-term returns. On top of that, most people simply don't have the time, experience, or emotional discipline to manage a portfolio well over decades, especially when it comes to their retirement savings. When markets fall, they panic sell. When market rise, they try to FOMO. And over time, this causes the average investor to underperform the market itself. This is exactly the problem that the government is trying to address with the Lifetime Retirement Investment Scheme. So with this new scheme, instead of expecting CPF members to become a skilled investor and constantly making the right investing decisions over 30 to 40 years, the LRIS aims to offer a much simpler way to invest. One that removes complexity, removes emotional decision making, and relies on structure rather than skill. Quick pause. If you're looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry, at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. So then, how does the LRIS work? Here, at the center of LRIS is what's called a glide path strategy. It sounds sibei, but the idea is actually very simple. It just means that the portfolio automatically adjusts your investment mix over time based on your age. So when you're younger, say in your 20s or 30s, the LRIS portfolio will be weighted more heavily towards equities, aka stocks and other growth assets. The logic here is straightforward. When you still have many years before retirement, you can afford to ride out any short-term market ups and downs in exchange for higher long-term growth potential. Then, as you get older, the glide path gradually kicks in. Each year, a small portion of your equities is sold and reinvested into lower risk assets, such as bonds and cash-like instruments. This is to reduce volatility and protect the gains that you have already built up, especially as retirement gets closer and you have less time to recover from major market crashes. Then, once you reach 60, the scheme goes one step further. Instead of waiting until you hit retirement age and selling everything at one shot, the LRIS will start to slowly liquidate part of your portfolio in stages. This phased liquidation is meant to provide members from being forced to sell all their assets during a market downturn, which is one of the worst things that can happen right before retirement. The proceeds from this gradual liquidation are then transferred into your CPF retirement account up to the full retirement sum. This will directly help to boost your monthly CPF life payouts later on. And then any remaining proceeds that exceed these sums will flow back into your ordinary accounts. So in essence, this scheme does all the heavy lifting for you. You don't have to pick individual funds, you don't have to constantly monitor markets, and best of all, it's designed to minimize the kinds of mistakes that many CPF investors have made in the past. Now, this investing approach is actually not new at all. In Hong Kong, the Mandatory Provident Fund already offers something very similar through its default investment strategy. Under this scheme, younger investors are invested more aggressively for growth, while older members are gradually shifted into safer assets as they approach retirement. The entire process follows an age-based glide path designed to reduce risk automatically over time. In Australia, the same idea is widely used through its MySuper Life Cycle funds. Most Australians don't actively manage their superannuation portfolios themselves. Instead, they are defaulted into age-based funds that automatically adjust their risk exposure as they grow older. In the United States, the 401k plans commonly use target date funds from providers like Vanguard. These funds follow a predefined glide path that gradually moves from equities to bonds as investors approach retirement, so as to reduce behavioral mistakes and improve long-term outcomes. In fact, even right here in Singapore, we already have many similar glide path portfolios. For example, there's the DBS Retirement DG portfolio, which uses an age-based investment strategy that automatically adjusts risk as you move closer to retirement. Then there's also the core portfolio by UOB AM Invest, which similarly uses a glide path solution to manage risk dynamically over time. The only problem is that they are only available for cash investments, so you can't really invest your CPF money in them. This means that today, if you want to replicate a glide path strategy using your CPF savings, you have to do everything manually. You need to decide how much equity exposure to take at different ages, rebalance your portfolio regularly, and figure out when and how fast to de-risk, all on your own. And for most people, that is sibei mafan. Now, so far, here are some of the details that we already know about the LRIS. First, similar to the existing CPF investment scheme, participation in the LRIS will be entirely voluntary. So, if you don't want to invest your money, no problem. You can continue to keep your CPF savings in the risk-free 2.5% and 4% accounts. But if you are willing to take on some risk in exchange for potentially higher long-term returns, you can choose to invest your CPF money through the LRIS instead. Second, the CPF board will work with 2 to 3 commercial product providers to offer a small number of curated life cycle portfolios. Industrial engagement is expected to begin as early as March, with selected providers announced in the first half of 2027, followed by the scheme's launch in the first half of 2028. Next, there are no official details on fees yet. CPF has stated that the all-in fees for the scheme, including total expense ratios, rep fees, and distribution costs, will be capped to keep fees low for investors. If you look at similar retirement systems in other countries and the CPF Advisory Panel's past recommendations, we can expect that total fees could be around the 0.5% range. As for returns, there are also no guarantees, as they will still depend on market performance. Historically, however, global markets have delivered decent long-term returns. From 1901 to 2022, a 100% global equity portfolio returned an average of 8.1% per year. And as bond allocation increases, average returns fall, down to around 4.7%. But in exchange, the portfolio would experience lower volatility and lower drawdowns. At this point, some of you might be thinking, if long-term investing is the goal, why not just buy a globally diversified fund like VWRA and call it a day? And honestly, that is a very good question. A globally diversified fund gives you exposure to thousands of companies around the world. It is low cost, simple, and over long periods of time, it has historically delivered returns of around 8%. In theory, during retirement, you could slowly sell portions of your portfolio when markets are good and rely on CPF life payouts when markets are bad. However, the problem is that most people don't actually behave this way in real life. That's because investing during your working years is emotionally much easier as compared to investing during your retirement. If markets crash when you are younger, you can tell yourself, never mind, I don't need the money yet, and I still have money income to continue investing. But during retirement, the situation is very different. When market crash during retirement, you not only have less money to live on, you also no longer have any income coming in to buy the dip. Historically, even a globally diversified equity portfolio has experienced drawdowns of close to 50% within a year. So just imagine seeing half of your retirement portfolio disappear on paper. For most investors, that's enough to cause panic selling and be like, huh? Not only that, it can be very jialat if the crash happens early in retirement. This is also known as sequence of returns risk. If you start retirement with a major market downturn, your portfolio will shrink much faster, and even if markets recover later, you may never fully catch up. In extreme cases, this can increase the risk of running out of money later during your retirement. That's why LRIS is very helpful. By gradually reducing risk as you age and introducing phased liquidation before retirement, the LRIS is specifically designed to manage this risk. But more importantly, it protects you from sabotaging your own self, whether it's from panic selling, poor timing, or emotionally driven decisions at the worst possible moments. However, with that being said, for experienced investors who know what they are doing, the LRIS may feel restrictive. You won't be able to choose your own holdings or stay fully invested in equities if markets are doing exceptionally well. Also, when markets are doing well and everyone online is haolianing, you probably can't haolian together because your portfolio is already more conservative. In short, the LRIS is not designed to maximize returns at all costs. Instead, it is designed to maximize the chance that the average CPF member ends up with a good retirement outcome. And for most people, especially those who don't want to actively manage their investments, that trade-off may actually be worth it. Personally, I'm looking forward to seeing how this scheme is implemented, and I'll definitely let you guys know whenever there's a new update. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.